Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now it's the 1st of June and that means it's the first day of Fed quantitative tightening. Now, this means the Fed will start reducing its holdings of US government securities and mortgage-backed debt, initially by $47.5 billion a month, but gradually accelerate that to $95 billion a month. Now, will it be as uneventful as watching paint dry, as Janet Yellen once described quantitative tightening back in 2017? Initially, it is possible. We've not seen that many episodes of QT so far, but during the 2018 episode, equities initially continued to do okay, even as bond yields rose. Now, risky assets did eventually fall at the end of 2018, but this was simply telling us that overall financial conditions, which are a combination of a number of factors, including overall rate hikes, are the indicator to watch as we go into the rest of this year and next. Now, staying with the US for a moment, one key economic data release we got received yesterday was the Conference Board Consumer Confidence Indicator. Now, this did fall moderately, but not by nearly as much as the University of Michigan indicator. Recall, it's a key indicator of growth concerns because while one would expect consumer confidence to soften as the Fed removes accommodation, too much of a fall can create more significant growth concerns, as our own recession checklist points out. Now, we would instead now keep a sharp watch out for the ISM manufacturing indicator of business sentiment that's due tonight, as that can provide a strong indicator of where economic activity currently sits, and therefore where the recent rebound in equity markets is showing signs of being sustainable. Now, it's in the US, but of course it was an active day in Europe as well. Eurozone inflation for May jumped to a record 8.1%, which was higher than markets expected. Now, while much of this is still led by energy prices, core inflation also rose significantly higher than markets expected to 3.8%. Now, energy price pressures are unlikely to abate immediately, as we noted yesterday, based on an EU agreement to embargo Russian oil imports, except for pipelines, and an agreement overnight to ban insurance of Russian oil cargoes, both of which pushed oil prices higher. However, it is likely to intensify the debate on the pace at which the ECB should raise rates. Now, ECB Chief Economist Lane said that a 25 basis point hike in July and September was the baseline, but several governing council members have publicly supported 50 basis point rate hikes. For investors, recall that any further rise in rate expectations is positive for the euro, which is where the impact may be most immediate and material. However, we'd also keep a close eye on the spread between German and Italian government bond yields, because while this remains far from worrying levels for now, it has been one source of stress for markets in the past decade. Finally, over in China, the official PMI for May showed an improvement in activity to 49.6 in May, which was up from 47.4 in April and better than what markets expected. But it does remain below the 50 level separating expansion from contraction, which of course indicates the post-COVID restrictions recovery has further to go. From a forward-looking basis, though, China's cabinet did announce 33 measures to support its economy, including expanding infrastructure spending, stimulating car and appliance consumption, and encouraging healthy development of platform companies. Now, overall, these announcements and upside surprise in the PMI relative to current expectations do fit into a broader positive view on Chinese equities and dollar bonds, given we're seeing, first, upside surprises relative to very low expectations, and second, a continued turn in the policy environment, which is a key assumption behind a positive view. So overall, potential opportunities in Chinese equities in the euro, but a bit more data in the US to watch as we go through the rest of this week to gauge just how strong economic growth is. But we'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.